When we talk about the global economy today, one of the most powerful tools that the United States wields is its economic sanctions. These sanctions, which are essentially restrictions or penalties imposed on countries, entities, or individuals, are designed to influence behavior without the need for military action. Over the decades, the U.S. has developed a sophisticated system of sanctions targeting countries from Iran to North Korea, Russia, and Venezuela. But beyond their immediate political goals, these sanctions are reshaping the very landscape of global trade. Sanctions work in several ways. They can restrict access to the U.S. financial system, block imports or exports, freeze assets, or prohibit American companies from doing business with the targeted entities. The underlying principle is clear. The U.S. economy is so central to the world that being cut off from it can severely impact a nation or company. For many countries, compliance is not optional. Global banks, multinational corporations, and even small exporters must consider the risk of violating U.S. sanctions, as the consequences can be severe, including hefty fines and exclusion from the global financial network. The impact on global trade is profound. Countries facing sanctions often have to find new trading partners or alternative financial channels. For instance, when the U.S. imposed sanctions on Iran, the country could no longer easily sell its oil to traditional buyers in Europe and Asia. To cope, Iran strengthened trade relationships with non-Western nations and even developed mechanisms to bypass conventional banking routes, such as using local currencies or barter arrangements. This created a ripple effect in global trade patterns, forcing countries and businesses to adapt or lose opportunities. Sanctions also accelerate the diversification of global supply chains. Take Russia, for example. Following the 2022 invasion of Ukraine, the U.S. and its allies imposed severe sanctions on Russian banks, energy exports, and high-tech imports. Companies in Europe and Asia that relied on Russian resources had to scramble to find alternatives, which has led to shifts in sourcing, logistics, and investment strategies. On the other side, Russia turned to countries outside the Western sphere, such as China, India, and Turkey, to maintain its trade flow. This reorientation is slowly creating parallel trade networks that may operate independently of traditional Western-dominated systems. Another significant consequence is the challenge posed to multinational corporations. Firms that operate globally must navigate a complex web of regulations. Even if a company does not directly deal with a sanctioned country, it may still be affected if its partners or clients are involved. This has led to increased compliance costs and the need for sophisticated risk management systems. Some companies choose to completely exit markets exposed to sanctions rather than risk violations, which in turn affects local economies and workers. Sanctions can also spur innovation in financial systems. Restricted countries often develop alternative mechanisms to bypass limitations. For example, some nations are exploring digital currencies, barter trade, or regional payment systems to reduce reliance on the U.S. dollar. While these initiatives are still in early stages, they reflect a broader trend. U.S. sanctions, intended to isolate, can also motivate countries to build resilience and independence in global trade. At the same time, sanctions can inadvertently affect non-targeted countries and businesses. Companies in Europe or Asia that previously traded freely with sanctioned countries face lost revenue or the need to find new customers. Shipping routes, insurance costs, and trade financing become more complicated. The result is a global trade environment that is less predictable and more fragmented. Businesses must constantly adapt, diversify partners, and assess geopolitical risks, which increases operational complexity and costs. U.S. sanctions also highlight the geopolitical power of the dollar. Many sanctions rely on the centrality of the U.S. financial system, as transactions denominated in dollars or routed through U.S. banks can be monitored and controlled. This has reinforced the dominance of the dollar in global trade, but it has also motivated some countries to reduce their dependence on it. For example, China and Russia have increasingly promoted trade in local currencies, and some Asian and African countries are exploring alternative settlement mechanisms. Over time, this may lead to a more multipolar financial system, changing how global trade is conducted. Moreover, sanctions are influencing investment flows. Investors, whether individual or institutional, are increasingly cautious about exposure to countries or companies under sanctions risk. Capital may be diverted from sanctioned regions to more stable markets, affecting global growth patterns. On the flip side, countries seeking to attract investment in the face of sanctions may offer incentives, create local partnerships, or develop domestic capabilities, which can reshape industries over time. It's also important to note that while sanctions aim to pressure governments, their effects often trickle down to ordinary citizens. For instance, access to goods, technology, or even basic services may be disrupted. In turn, this can affect global trade by limiting the availability of certain products or shifting demands to alternative sources. Companies that previously relied on imports from sanctioned countries may have to find substitutes, leading to price fluctuations and supply chain adjustments worldwide. In conclusion, U.S. sanctions are much more than political tools. They are powerful levers that shape global trade. They influence the flow of goods, capital, and services, encourage the diversification of supply chains, and accelerate the creation of alternative financial systems. While sanctions are intended to achieve specific geopolitical objectives, their ripple effects are felt across continents, affecting businesses, governments, and everyday consumers. As global trade continues to evolve, navigating the landscape shaped by U.S. sanctions has become a central challenge for policymakers, corporations, and investors alike. The balance of power, the choice of trading partners, and the structure of financial systems are all being reshaped in real time, and the long-term consequences may redefine the global economic order itself.